Hi, hello, and good evening, and thank you. And I want to thank you for allowing me to come into your world, wherever you may be, on your phone, in your car, somewhere, wherever in the world. I decided to make this little short video real quick. I don't know if I can do anything real quick, but this month is supposed to be what's called National Insurance Life Insurance Month. And so I'm an individual who has been involved in the insurance industry for the last 20 years. I am, in fact, an insurance industry professional. I know a lot about life insurance. I know a lot about insurance investment products such as index fixed annuities and variable annuities and life insurance products. And one thing I've realized in those 20 years is a lot of people, so many people, are very, very ignorant about insurance. For example, a person would not, well, some people say, well, because I have a mortgage, I have to get homeowners insurance. So, I mean, they might be wise enough to forego homeowners insurance when their homes have been paid. And it's not a wise idea, and I'll tell you why a little bit later. Because if you own a $500,000 home, I mean, really and truly, if you had 100% loss, where are you going to come up with a $500,000 out of your pocket to replace that home? So we walk around. Some of us had the great opportunity. We go to college, we graduate, we get a job straight out of college. We go on to work a job, and some of our parents and our mentors never taught us anything. Many of us are very, very ignorant when it comes to the management of money, when it comes to the protection of money, and when it comes, you ask most people, what are they working for? They say, I'm working to pay bills. Excuse me, very few people say, I'm working, that one day I may move from one social economic status to another. They don't understand that plan. Or the people say, oh, I just want to be a millionaire, but they don't even know what effort it takes to be a millionaire. And a lot of people are already a millionaire. And all the things they say they would do when they become a millionaire, they still haven't done it. They're still not doing it because there are many millionaires around us. I like to refer to it as the millionaire next door, or the blue collar millionaire. If you look at me, you might not know. It's quite possible that I'm a millionaire, that I have assets in excess of $1 million or more, but I'm not going to discuss that with you today. That's not why I'm here. I'm here to talk to you about life insurance and the importance of life insurance. There's some things in life that no matter how much money you make, people say, I don't make enough money to save. My dear friends and foes alike, supporters and detractors alike, I want to tell you, the less money you make, you cannot afford not to save. So, in other words, even if you're making a very small amount of money, you must, for every dollar you make, you have to be able to save 10 cents or 20 cents on the dollar so that when the time comes and you fall on hard time, you've got a rainy day fund to fall back on. Now, no one goes into a dealership and buys a new car and be told that they have to pay $500 a month or $300 a month or $600 a month for their car note plus an extra $300 or $400 for auto insurance. They never say to that salesperson, I can't afford it. They say, oh, I'm going to look good in this car and I'm going to come up with that $800 a month to pay the car note and to pay the insurance note. Now, you would not drive around, or even if you say, oh, if it wasn't on a note, I wouldn't have insurance. That's not true, because then you say, oh, because it's the law, so I'll have auto insurance because I can't drive without it. Well, the reason why they had to make it a law because they know what happens, because there are going to be accidents. You're going to have property damage. People are going to get hurt. And in order to spread the risk, that's what insurance is all about. It's about sharing the risk, passing on the risk among a pool of people so that no one person feels the pain. Now, imagine how important it is to you to have that automobile insurance. Imagine how important it is to you to have that homeowner's insurance. And then you get a job, and the job offers you on that job. Sometimes they tell you, hey, look, when you go to orientation, they say, look, we offer you life insurance, and you can get one time your pay by default, and we'll give you up to 10 times your pay, up to a maximum of $500,000, or up to a maximum, depending on your grade or what you use on the job. And yesterday you weren't making any money, but today you're working that job and you feel you're not making enough because you're making $30,000 or $33,000 or $35,000. Maybe you're making 40, maybe you're making 50, and you're complaining. You complain. Yesterday you had nothing. Yesterday you had no job. Today you have a job making 50, and now you're complaining. Now you're saying you can't save, but yesterday you had nothing. Then you come on the job and they offer you some benefits, and you say, oh, I can't afford that. I need my money. I need my money. I got to shop. I got to go on vacation. I got to have a good time. So what I'm trying to tell you here is that when you had no money, you had nothing. And when you started, even if you started at 25,000, at 20,000, or even at 10,000, you cannot afford not to save. Then when you join a job, remember you had nothing. Now you come in, you're getting 30. And they offering you life insurance, which is part of a group plan. So it's very cheap. And to get in, you don't have to prove your insurability if you take it on the first day that you join the job. Then they offer you long-term and short-term disability, and these are going to cost you at the most $5, $6, $7, $8 per pay period. And you say, oh no, I can't do that. That's $6 I could use in my pocket, which is really a bad financial decision, because a lot of these types of things, health insurance, you can't even go to the doctor. When you call on the phone, they don't even ask you what are you suffering from. They don't even ask you what you want to say. What is your insurance? And then they ask you, well, we don't take this plan or we take this plan. They never ask you, well, can you just pay out of pocket? So that's a whole commentary for a different segment. So we have all these different various classes of assets, right? You get on the job, you got cheap insurance being offered to you, you're making 50, you're making 30, you're making 40, whatever it is, but you feel like you cannot pay a little $5 or $6 per pay period to ensure that if something happens to you, things are already tight as they are. Imagine what will happen if you die suddenly and your family no longer have access to that $30, $40, or $50,000. And right there on the job, they give you the opportunity. That's the first opportunity that we get to have life insurance, to have certain protections, and many of us don't take it. Or some of us, when I come to you or other agents like myself approach you, say, oh, I have insurance already, I have it on the job. Well, the job is not guaranteed. What you have on the job is only good as long as you're on the job. And when you leave the job, it could be portable, but you got to pay for it when you port it. Okay? So we try to teach people that it's very important to establish a life insurance policy that is independent of your job, that belongs to you, that no matter what happens to your job, you still have your policy. The other thing we try to explain to people is that insurance depends on your age and your health. The insurance company is not standing in line knocking on the door to underwrite you and to insure you, because they're betting that you're not going to die. You're betting you might die. We will all die at some point. Some of us will die before each other. Some of us may die suddenly. And it leaves a void in our families, a financial void, an emotional void, because guess what? It costs money to be born and to come into this world. The hospital is probably still chasing down your mother and your father for the bills they didn't pay when you were born. And when we die, it costs even more money to get us out of here. You understand? Some of the wealthiest people and the most well-to-do people in our society are the people who own funeral homes. Funeral homes is a recession-proof industry. And they did extremely well during COVID-19. They do extremely well throughout the year because people must die. People must die. We all are heading towards the final exit and towards the final departure. But let's look at asset classes. What is the most important asset that we own? The most important asset that we own is the geese that lays the golden egg, and that is ourselves and our lives. and the lives of our offspring, or what you call your children. Imagine your bundles of joy, your beautiful little baby boy, your little baby girl, your young son you're so proud of, who is doing so well in high school on the football field. And as you know, anything can happen at any time. He can come down with a sports injury, which the school and the school district is not liable for. He can suddenly die during training, like has happened to many youngsters. And then depend on your profession. I mean, any one of us, depending on our profession, if you're in the military, the insurance company itself say, hey, are you going to be on a plane as a passenger, or are you going to be flying a jet for the military? They know if you fly in a jet, you're involved in war, the possibility of your death or your dismemberment is much higher. They may insure you, or they may not, or you may be raided. But hopefully the military have arrangements to provide some type of life insurance coverages for members of the armed forces. Similarly, if you work as a police or you work as a firefighter or certain types of professions, very often we see on the TV somebody, who is involved in law enforcement gets killed, and they have to ask for help to help his family or her family. And it's also a sign that they didn't have an adequate amount of life insurance. They didn't have money enough to take care of the death, to take care of the burial, and to have money for the family to continue to sustain itself in the absence of that income. So this is a gap in most of our financial planning that we miss. And I call it an umbrella because it protects you from those rainy days, okay? So when you start off your life, when you start off your career, when you start off your financial plan, one of the first things you should look at is, are you adequately insured? Do you have enough life insurance? Do you understand the importance of life insurance? Do you understand that life insurance is something that you could use sometimes while you're still alive, and something that you could, with the way the products are today, and something that you could also use to ensure that those who survive you will have something so that they will not cry twice. They're not going to cry because they miss you, and then they're crying because they're broke and they have to beg people for help just to bury you or to cremate you, even if they're giving you the cheapest of the cheapest of funerals, which is cremation. They still cannot come up with $8,000, $9,000, or $10,000 or $7,000. So what am I saying? I'm saying to you that our most important assets are our lives, and we shouldn't walk around without our lives being insured. Okay. Now there are different types of insurance. This industry is a very controversial industry, but insurance in every case is a contract. If you have homeowners insurance, it's a contract. If you have automobile insurance, it's a contract. It's an agreement between you and the insurance company in exchange for consideration, which is the premium that you pay monthly every 6 months or every year. They agree and they promise you that if anything happened to your automobile, they will fix it, they'll replace it. If you have medical injuries, they will contribute towards it. The same thing goes for your home. If something happens to your home, if you have a catastrophe, if you have well, we don't know, you got to get separate flood insurance, but let's say you had strong winds, you had a tornado, you had a hurricane, whatever, it might be more difficult to get insurance now in places like Florida, but here in Texas, at least we still have some affordable insurance. Let's hope it stays that way. But if something happens to your home, if you have a loss, if you've got destruction by whatever means, the insurance company makes a promise that based on X, Y, and Z, if B, C, D occurs, they will pay you, they'll keep their promise. Because very often if something happens and you have, say, $35,000 or $50,000 in damages to your home, you don't have the means to get that money out of pocket, because the average citizen in the United States of America cannot come up with $500 for an emergency on short notice. Okay? So it costs us money to come and it costs us money to leave. Let me explain to you the different types of insurance. So long ago, there's just one type called whole life. And that whole life insurance, really was like a trick. The industry has undergone many changes, and some of you, the only thing you know and the only thing you remember is whole life because somebody tried to get it to you and it just didn't work out. Well, fast forward, the industry evolved. They came up with, I think they had term back then too. And as it depicts itself, it's called term. Term is for a fixed period of time. The maximum amount of term insurance you can get is 30 years. And very often, term insurance is cheaper than what we call permanent insurance. I call it full time because nothing in life is permanent. And so, what I'm saying to you is that this term insurance, you get it for 20 years, 25 years, and the most you can get it for is 30 years. And a lot of people advise you, you see, back in the day, they had A.L. Williams. A.L. Williams became Primerica. And a lot of advisors, a lot of people say to you, hey, buy term and invest the difference. Buy term and invest the difference. So I don't have a problem with that. I think term has its applicability. But the issue is that I feel we all need life insurance up until we die. And some of us may die shortly, some of us may live forever. One thing you're guaranteed, because of the promise of the life insurance company, assuming they stay in business, they've got a good rating, they got a good paying ability, they have reserves, and they have been good fiduciary of our money. If you can keep a life insurance policy until you die, you're guaranteed to have something. Because the longer as you get old, if you get clinically or terminally ill, these insurance policies have what's called riders. They have a accelerated death benefit rider. They got a disability rider. They got a long-term illness rider on some of the products they have now. So that means while you're still alive, if it's determined that you have a critical illness, if it's determined that you cannot dress yourself, you have a disability, you can begin to draw money from some of these policies so that you can afford a better standard of living while you're ill. You see, term insurance doesn't give you that. Now, the other problem I have with term insurance, they say to buy term and invest the difference. It appears that the investing of the difference never works out. Because all the people I know who invest the difference, sometimes you have people out there, as soon as they have $1,000 or $5,000, they got to go and they got to do something. They got to go shopping. They got to go on a trip because they have that itch. They have that itch. They don't have that discipline about holding on to money, keeping money, and building money. And they say they want to be a millionaire, but they don't have millionaire discipline. You see, you've got to have millionaire discipline. You've got to have millionaire attitude to accumulate millionaire money. Okay? So now you've got term, and you should get term if you can. So if you got $1 million term policy for 30 years, it's costing you $100 a month. Why not? If something happens along the way, it only adds to the pool. I don't think there's anybody in the world, any member of any family, even myself, if I were to pass away after I'm done making this video, that my family members wouldn't be happy that at least dad is gone, but dad was able to accumulate certain assets in certain classes, and dad was able to leave us enough assets that we could give him a good send-off. We can cry, but we're not going to go and beg anybody to say we need money to take care of our father's final expense because he didn't have shit. Similarly, one of the problems I've had with this industry is, and it's changed now, because when I had children, I could not buy insurance on my children. A lot of people say, oh, my parents have a policy on me, or they bought it when I was young. Well, guess what? It's just a $25,000 policy. It's just a burial policy. And by the time they finish burying you, there'll be no money left over to buy liquor to celebrate your life. So in our household, we have a different concept. When I came into this industry, I was very passionate, and I still am passionate. I always felt that you should try to ensure the young people, because by the time the young people mature, by the time they get in their 30s, by the time they start having sex, by the time they start getting venereal diseases, by the time they start drinking alcohol, snorting cocaine, smoking marijuana, doing all of the things that can bar them from being insurable, right? It's good to insure, I call it to protect the insurability. So the earlier you get a policy, the cheaper it is, the longer you have time to fund it, and the policy, if everything goes well, could at some point accumulate enough cash that it could take care of itself going forward. But these things have to be planned early in life. So many people and many of the people out there say, well, we only want to insure the people that we're dependent on, and if something happens to them, we don't have their income, the insurance will replace it. But I tell you, no, it's not true. Because if your bundle of joy, and go and talk to all the parents out there and all the people out there who had to wake up and hear something happen to their daughter or to their son in an automobile accident, or they were shot, or they were killed by the police, or something of that nature. And they're crying. They're crying. And all that child left them was a car note and an apartment rent. And now they have to go and try to put that child's business together. The child didn't even have a will. So imagine this. This same child is a child you would hope when you grow old would help look after you, would make sure you weren't beaten up in the nursing home, would bring you a cup of water, would come to visit you. While you're ill. While you're ill, what if that person is no longer there? You know, it is all our intention. It is all our intention, which is good, and which is supposed to be the nature of things, that the parents will precede the offspring. But it doesn't always work that way. And I remember sometime I spoke to people about buying life insurance for their parents. And some people are very evil, very cruel, very. One of the things you have to know to be in the industry of selling insurance, an insurance business, you have to be very strong. You have to be like strong, like a young raging bull. You have to be able to take insults. You have to be able to take put downs. You have to be able to take rejection and still be able to wake up and smile and hold your self-confidence together and keep on going. And the sad thing is that many of the things I've spoken to people about over the years have transpired. And sadly to say, the things I speak of, which I don't like to speak, because one of the reasons why I've broken down is because I always imagine the possibility of such eventualities and how hurtful it would be. Insurance money will never take away your pain. Insurance money will never return your husband to you or your wife to you. Insurance money will never return your daughter or your son to you. All insurance money will do is carry over, because when you go through these traumatic changes, you will not be able to wake up in the morning and go to work. And no matter how much you pretend that you're going to work to keep your mind off it, when you have a loss, a tragic loss in your family, if you lose your wife of 30 years and whatever else, I don't like to talk about things because of my spiritual strength. If I think of too many things, I talk about things, things happen. So I don't want to mention certain things. And I don't want it to happen to you. But all I want to tell you is that it is very important to have and to maintain life insurance. A lot of people, as soon as they lose their job, they get rid of their life insurance. A lot of people think, well, oh, that extra $150 or that $200 I'm paying for $500,000 of life insurance, I could use that money towards a trip. I could use that money towards some liquor. And the truth is that you are, in fact, protecting yourself and saving for your future. Because if the day comes that, let's say, all you had left was that policy, and had a nice cash value in it, you could sell it in a vertical settlement. You can get living rider benefits. And if somebody have to help to care for you, you can say, you know what, I will leave you this insurance policy. Okay, you help me out. And when I leave, you can have what's left from this policy. It's a negotiable asset. Okay, let's put it that way. So you've got whole life, you've got term, and then the industry evolved to what's called universal life, flexible premium, flexible universal life. So you could start off at 500,000, and if you feel like, hey, I don't need all that anymore, and you want to drop it to 250, and it lowers your premium, you could do that. It's flexible, okay? Then the industry evolved to what's called the index universal life insurance. And what these are is actually different products that have offer you more flexibility than whole life. Goes for a longer term than term. The industry refers to it as permanent life insurance. And what it does is that it provides the umbrella for you. So if you die, you get your beneficiaries get to have some money. And let me also tell you that insurance death benefits are tax-free. They go to your heirs or to your beneficiaries tax-free. Similarly, with index universal life, the cash value, so in universal life, they have a declared interest rate. Some time ago, long ago, these policies used to do very well. They paid 9%, 12%, 8%, universal life policies. Insurance company products and annuities are a class of assets that different people can invest in. Some of them are very conservative, but one thing you can be assured of is that the insurance companies, so long as they're not mismanaged, so long as those executives do the right things, and you have some stopping power from the state and even from the federal government should anything go wrong, as you saw with AIG Valic in 2008 and 2009, they will be bailed out because they're too big to fail, because they have so many people, retirees, that get paid by Valic. Valic was in all of the universities in the United States and all of the K through 12 school districts. So a lot of teachers, a lot of people depend on Valic for their retirement, and that's why the US government had to bail them out. They were too big to fail. So what I'm saying to you now is that index universal life, like the general universal life, the difference of the index is that your cash value can go in interest based on the performance of an index. Your money is not in the stock market, but it's pegged to say the S&P 500, the Dow Jones Industrial, the Russell 2000, and now they're coming up with all of the fancy indices, such as the Fidelity Index and the Goldman Sachs Index, and all of these creative people on Wall Street who are mostly physicists and mathematicians come up with these formulas of how they're going to calculate and get options with your money and guarantee you that they can give you and the caps are very low now. They used to be higher. So you would get, an 8% or 9% return on the cash value of the money in the index universal life insurance policy. As that cash value grows, now mind you, later on you can access it. You can make what's called a partial withdrawal. Okay, in the case of the index universal life and the case of the universal life, there are two ways that the death benefits are paid. There's an option called A and an option called B. Option A is just the face value. So what it is that if you have $50,000 in this policy, or you committed $100,000, The cost of insurance for you over time is cheaper in option A, because what it is that if you have 100,000, so your death benefit is 500,000, you got 100,000 in cash. The insurance company is only going to go out of pocket 400,000, because they're going to take that 100,000 cash you have, put 400 on it, and pay you $500,000, and that's it. Okay, so that's called option A. Option B is the face value plus the cash value. What does that mean? That means that if you have a $500,000 life insurance policy, you have accumulated $100,000 in cash value, and you were to pass away, your death benefit will be 600,000, because it will be the face value, which is the 500,000, plus the cash value, which is 100,000. Similarly, while you have that 100,000 in cash value, you are able to go in and take a loan against it, which is not income, or you can do a partial surrender, and it does not affect the face value of your policy. You see, that's different with whole life. When you take money out of a whole life policy, it can cut the death benefit in half. But that is not the case with universal life or index universal life. And these are some of the preferred features of that product. And so those people come to you and say to you, oh, buy term and invest the difference. They have no clue, because we need insurance until we die. And if we're able to get it whilst we're young, whilst we're fresh, whilst we're virgins, that's the best time to get it. And if you have offsprings or children, the best gift that you can give to your children or to your offsprings is to make sure you get them life insurance while you can and while they're still insurable. In my case, I was able to protect the insurability of my offsprings, even though I didn't really have the means. And some of the policies I get them are not the best policies, but nonetheless, they are policies. And if we can maintain them and pay the premium, we can do the mathematics. Even if they live to 90 years, the amount of premium we paid will never equal what the insurance company has to pay in the death benefit. Additionally, we are accumulating cash in all of these policies. And one other secret I want to tell you, any money that you have in an insurance policy or in an insurance industry product, such as an annuity, an index annuity, a fixed annuity, cash value life insurance, that money is protected from your creditors, is protected from bankruptcy, and is protected from being attached unless you acquired it fraudulently. Okay, and the only thing it's not protected from is child support. So you got child support is the one and only thing you can't get away from. But other than that, I'm not sure. I think you might be able to not have to pay child support, but we'll have to examine that closer. But however, it is protected from creditors. When you declare bankruptcy, you don't have to liquidate it to satisfy the bankruptcy requirements. So as part of National Life Insurance Month, I've seen many people in my time. I've witnessed many friends, and I've heard of other people who have passed away in the prime of their life. I'm fortunate to have reached close enough to the twilight of life, for which I'm grateful. And I still feel strong like a young raging bull. I'm still passionate about talking to people about finance and about money, even though it's a very difficult subject, even though it's like pulling teeth. And people fight you until something happens. Many people come looking for life insurance after somebody has died. Many people call you and ask you for life insurance when they are on the verge of death or they are very ill. But when you came to them in their youth and in your youth, and they say, hey, this is what you should do. They shoot you away. They shoot you away because they're so smart. They're so intelligent. They have so much college education. They have so much degrees and they have so many honors that they feel they're better than you, an ordinary insurance sales guy like me. So anyway, if there's one good piece of advice I can leave you with tonight, is to tell you, yes, these are basic things you have to do. When you get a job, take the extra life insurance for the maximum of your pay, regardless how big or how small your pay is. Get long and short-term disability on the job. Get the health insurance. Don't ever say you can't afford it, because you can't afford it if you have to pay out of pocket, and those people won't give you health care. They don't care what insurance you have. Better to have something than nothing. Um, the most important thing is your life. That's the biggest asset you have. You can replace a car, you can replace a house, you can replace a lot of things, but you can never be replaced. And when you're gone, you don't want your family to cry twice. You don't want them to be embarrassed that they have to call Mike, they have to call Peter, they have to call Geoffrey, they have to call Freddie, they got to call Tony, they got to call Ismail, they got to call Abdullah, they got to call Ibrahim to say, hey, could you please help me? Because we need to raise some money to bury Peter, and Peter did not leave us anything. And that's why I'm passionate about it. Moreover, I'm even more passionate about the fact that you have to encourage your offsprings who are young in their 20s and in their 30s to purchase permanent life insurance, not term life. Because if you buy term life at 20, at 50, it's no good. And at 50, you're still in your youth and you still need insurance. But if you buy at 20 years old a permanent life insurance that we've illustrated up until you reach age 80 or age 90, where you're going to have several $100,000 accumulating cash value, where you can manipulate the cash value of that insurance for things you might need to do along the way. You might even be able, if you do it right in your late 30s or early 40s, be able to pull money out of there to go and buy a piece of real estate. But real estate is not really the best investment. But what I'm telling you, because you see, if you've got 100,000 in cash value life insurance and you need $5,000, all you got to do is call the insurance company. But if you got $100,000 tied in a piece of real estate, it's not that easy to take $5,000 out of that piece of real estate. I'm going through it right now. I'm trying to unload some real estate, and I'm finding out it's a very, very interesting process. And many people along the way have told me, well, Peter, I can sell this property, I can sell my practice, I can do this, I can do that. It doesn't happen that easy and that quickly. The conditions have to be right. You got to find the right buyer. Nothing, people tell you, oh, your place is valued at this and that. Somebody has to come along who's willing, what you call a qualified buyer. That's a person who's going to come with the money that you want, and they're willing to part with that money in exchange for that asset. And these are basics of economics and accounting and all these other disciplines. However, remember, if you don't get help from me, you don't get help from us, get help from somebody. And I represent the Lander Financial Group. You can just do a search online, the Lander Financial Group. My name will come up, my address will come up, my phone number will come up. If you want to talk about life insurance, if you want to talk about annuity, if you want to talk about things financial, I've had my channel for a while. I've always wanted to focus on the financial aspects of things. But, I know many of you people are not serious. You're not going to come knocking on my door. You haven't done so for 20 years. You're not going to do it today. And that's why, for example, I didn't bother to dress up with a shirt and tie and a jacket and do all that because you're not deserving of that. You're not deserving. Why am I going to go get all pretty? I'm already pretty like this. So why am I going to get prettier for you when you don't reciprocate? You haven't reciprocated in 20 years. It's not today I expect you to reciprocate, but you can take the advice. And if you don't come to me, you can go somewhere else, go to somebody. Like they used to say in that drug commercial in the 80s, if you don't get help from us, get help from somebody. So remember, don't let your family cry twice. Crying twice. The importance of life insurance, the importance of having independent insurance from your job and permanent life insurance. You cannot afford not to have it. If you have automobile insurance, if you got renters insurance, if you got homeowners insurance, and you don't have life insurance, you're walking around unprotected. God bless you as always, and I'll see you soon. I hope you'll call me, the Lander Financial Group, Peter Lander, the one and only.